Revenue recognition principle. What is revenue recognition? In order to understand this, let's break it down. Firstly, what is revenue? Revenue is the income earned from either the sale of goods or the provision of services, where the sale of goods may relate to a homeware store and the sale of furniture, and the provision of services may be tax work provided by an accounting firm. Now, what is the revenue recognition principle? Well, the revenue recognition principle follows the accrual basis of accounting, meaning that revenue is recognized when it is earned, not when the cash is received. This means that regardless of when customers pay cash, revenues do not qualify as revenue earnings until the seller delivers the goods or services. To demonstrate, let's look at two examples, under the assumption that the accounting period ends at the end of each month. Scenario 1. Say you purchase an airline ticket in advance, on May 1st that departs on August 1st. The airline ticket purchased before the flight represents unearned revenue for the airline until the trip occurs. Until the month ending August, the company owes a service to the customer. Therefore, under the revenue recognition principle, revenue is recognized not in May, but in August. This is an example of deferred revenue. Deferred revenue is also classified as unearned revenue because at the time of the cash receipt, the company has not yet provided the promised service and therefore cannot record a revenue, but instead record a liability. Scenario 2. A telecommunications company bills a customer for their monthly phone bill, which is after the customer has already made phone calls and used their data for the month. The customer receives their June phone bill in July. So in this instance, the company would record the revenue in June and record the cash receipt in July. This is accrued revenue. Think of accrued revenue as accumulated revenue, as it occurs when a company provides a service and therefore is earning revenue before collecting the cash. So let's summarize what we have gone through. The revenue recognition principle captures business activity rather than when cash changes hands. A deferred revenue records revenue after the cash is received, so the payment is made in advance for goods that are to be delivered in the future. Accrued revenue records revenue before the cash is received, where the service is provided and then the cash is received. Thank you for watching.